I think there's the two issues that investors are really looking for here is a top-line revenue momentum as the company continues to migrate from the desktop to the mobile world. And we saw, number of paid clicks up better than expected, but the pricing down much worse than expected. But the second issue is cost. This is a new CFO.
You anticipated my question.
There we go. Great minds. So, the new CFO that has come in, Ruth Porat, several quarters ago, really put a greater focus on cost control, and that's driven profitability over the last several quarters. The EPS miss here, I think investors just want to get a sense from the management to the extent that they're still committed to, vigilant cost controls in the context of a very good growth story.
Well, speaking of a good growth story, let's bring in Anurag Rana for Microsoft. And, of course, all the numbers that came through are ex-LinkedIn, which Microsoft acquired. I'm looking at earnings per share on an adjusted basis of 84 cents when analysts were looking for 79 cents. Revenue coming in at $25.8 billion versus the consensus estimate of 25.3. And the different business lines all topped analyst estimates as well. Yeah. Was there any flaw here that you saw?
No, actually, it looks very clean to me. I mean, Azure numbers are very strong at 95%. Server numbers very good up. Even PC numbers, which have been, fairly weak on the consumer side, they were decent as well. So overall, I would say a little bit of a, good quarter from them from, almost all perspective.
Now, one number that came up was the unearned revenue, $34.7 billion. Talk us through what that means and when we actually see that earned.
See, the way it works is you have a large pool of that revenue that's on the balance sheet. And as it bleeds through time, and a lot of the times what could happen is timings of a deal or timings of a corporate deal, you could have unevenness over there. But, that could be a number that could have caused some little bit of a disappointment.
Paul, I want to go back to Alphabet for a second, because while they did maintain costs, that also means, some of this pulling back on investments of some of their other big moonshot bets. They still have the challenge of diversifying away from that core advertising business. That is anything else starting to fire for them, or are they still really dependent on it?
Yeah, I think when the bulls for the Alphabet story, they look at a couple of things. Look, number one, monetization of mobile. More and more search traffic obviously is going mobile, and they look for the ability of Google to continue to monetize that big surge in mobile traffic. Secondarily, they look at YouTube, online video. Online video is one of the fastest. It is actually the fastest growing areas of online advertising, digital advertising. And of course, with YouTube, Google's in a fantastic place there. So investors want to continue to see a very sharp ramp in revenue at YouTube. That is one of the long-term drivers for this story.
And one thing about Google, we look at other bets. Those are the moonshot businesses, right? That Sergey Brin had been working on. $262 million in terms of revenue. On an operating basis, it was a loss of $1.09 billion. Can you put some context around those numbers? Is that what we're looking for?
Yeah, it's generally, these are numbers since the IPO. This is a company that's spent a lot of money, capital expenditures, operating expenditures on these other bets. What they've now done is they've broken it out for investors so that we can look at the core growth dynamics of the core Google business and take a look at some of the growth and some of the losses and investments in some of these other bets. $1 billion is a big number on a quarterly basis, even for Alphabet. Investors just want to say, do you have some, constraints around the spending there that we can feel that it's not going to get out of hand and really impact the growth of the core Google business? So investors are going to want to hear context from the management.
Anurag, back to Microsoft for a second. I'm looking at this headline. Microsoft says its commercial cloud revenue run rate tops $14 billion. How is it matching up against Amazon, which is really the behemoth? And I know with Amazon, part of the enthusiasm is that it's just spinning off so much cash, that business, a lot of it dropping straight to the bottom line, more cash than Amazon knows what to do with it. How profitable is this for Microsoft, and how is it hanging in there?
See, it's not apples to apples comparison, because for Microsoft, a large portion of that is applications business. For Amazon, it's pure infrastructure work. So Microsoft does not break out the infrastructure business between them. So it's not a fair comparison from that point of view. For Microsoft, a lot of it is the Office 365, when you have your normal applications moving to the cloud. So there's a large portion of that. It should be, in theory, a lot more profitable than other businesses because it's been there for a much longer period of time.
All right, Paul Sweeney and Anurag Rana of Bloomberg Intelligence, thank you both very much.
Coming up, Richard Fain, Chairman and CEO of Royal Caribbean Cruises, joins us to talk earnings and whether or not he foresees travel and tourism changes in the wake of the Trump presidency. That's coming up. This is Bloomberg. What'd you miss? Tech companies not the only ones to report earnings today. Royal Caribbean Cruises beat the consensus with its bottom line, also issuing guidance that came in above analyst estimates. That prompted the stock to post its best day since October. CEO Richard Fain says Royal Caribbean has never been so well positioned. He joins us now from Miami. So, Richard, great to see you. Thanks for joining us today.
Thank you, Scarlet. Nice to be here.
As we mentioned, a beat on earnings in the fourth quarter. More significantly, perhaps, is your outlook for the first quarter and full year bookings look fairly strong. What would you say is driving the business right now?
You know, I don't know, but for quite a while now, we've seen a real enthusiasm in the consumer here in Europe and in Asia, and they are spending as we haven't seen for quite a while. They seem to be more confident. They're booking further into the future. They're booking better accommodations, and they're spending more on board, and sort of that's the trifecta for us.
Give us a sense of these customers. Are they old customers that are coming back and taking more cruises? Are they new customers that you're taking from your competitors? Who are they?
Well, about a third of our cruisers are past cruisers who know us well. A third of our cruisers are people who have never cruised before. And a third of our cruisers are people who have been on competitors but now looking for something better, I would say.
You mentioned that all regions around the world seem to be firing on all cylinders right now, including Europe. Europe had been a very weak spot for quite some time. When did you start to see this turn around?
So Europe has been a weak spot for quite a while now, actually quite frustrating to us. It's still not as strong as the U.S. The biggest strength really is here. We're seeing it in all of our markets across the country, really quite a level of enthusiasm that we haven't seen for a while. Europe started really, from our perspective, to pick up at the end of the summer into the fall.
Started to pick up after this summer. What is the outlook for 2017, especially with so many political events in Western Europe that may cause people to cut back a little bit because they're just not sure where things are headed?
Well, I think we saw over the last couple of years a very negative attitude due to a lot of the kinds of geopolitical events that you're alluding to, and that really has been a bit of a bummer. It's still not back to where we'd like to see it or where it was some time ago, but somehow they just seem to have now gone with the flow and seem to be accepting that better. So we're seeing not quite where we'd like it to be, but strong compared to where it's been. And I don't know of any event that's triggered that. It just gradually, we're very data focused, and we're just seeing it in our bookings and seeing it in the attitude of our consumers in terms of their spending.
The big news today for the world, or especially in the U.S., the ongoing antagonism between the president and Mexico, talk of higher taxes, the relationship not off to a good start, the meeting canceled. What are the risks for you if there's a Royal Caribbean, if there's a trade war between the U.S. and Mexico?
Well, the unfortunate thing is we are spread out all over the world, so any problem that happens anywhere, including between the U.S. and Mexico, is bad news for us. On the other hand, the good side is that we are spread out all over the world, and we have the opportunity to move our activities as we needed. But so far, I think we are simply so good for the U.S. economy and so good for the Mexican economy that I think we will probably do reasonably well, even if there is some disturbance.
What is your level of concern that perhaps U.S. customers won't want to travel to Mexico because of the rhetoric between the two countries?
You know, I have to admit, watching what happens in Washington and even Philadelphia is fascinating, and it's a lot of fun. But we don't actually have yet to see any real correlation between that and how our consumers actually operate. And I think the world is going on. Our customers are sailing like never before, enjoying it. Our satisfaction rates are higher. People are happier on board. So nobody likes to predict the future, but so far we haven't seen much correlation.
Richard Fain, Chairman and CEO of Royal Caribbean Cruises, thank you so much for joining us today.
Thanks for having me.
And meanwhile, Alphabet shares ticking lower after hours after some disappointing numbers. We'll have more insights into Alphabet earnings after the break. You see the shares down 2%. This is Bloomberg.
Emma Chandra. Let's get to First Word News this afternoon. President Trump says the plan to scrap a planned meeting with the president of Mexico was a mutual decision. He spoke today from Philadelphia, where GOP lawmakers are gathered for their annual retreat.
The president of Mexico and myself have agreed to cancel our planned meeting scheduled for next week. Unless Mexico is going to treat the United States fairly, with respect, such a meeting would be fruitless, and I want to go a different route.
The president also said most illegal entry into the U.S. was from south of the border. He's calling for a 20% tax on imports from Mexico to pay for the southern border wall. A former official in President Donald Trump's transition team says he expects the new administration to seek significant budget and staff cuts at the Environmental Protection Agency. Myron Ebell told the AP that he predicts the president may seek to cut about $1 billion from the EPA's $8 billion annual budget. He also says Trump will likely seek significant reductions to the agency's workforce of about 15,000 employees. The Border Patrol chief is leaving the agency. Customs and Border Protection said that Mark Morgan's last official day in office will be Tuesday. Morgan's departure comes a day after President Trump announced plans to build a wall at the Mexican border and hire 5,000 Border Patrol agents. Genetic engineers have successfully grown an embryo that is part pig and part human. Scientists injected human stem cells into a pig embryo and then planted the embryo in the uterus of a sow, allowing it to grow. After 4 weeks, the stem cells had developed into precursors of various human tissue types. Researchers cautioned the hybrid was inefficient, but a significant step toward the development of animal embryos with functioning human organs. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Emma Chandra. This is Bloomberg.
Thank you so much, Emma. Let's get a recap of today's market action. The Dow adding to its advance, closing at yet another record high, this time 100 points above that 20,000 level. The S&P and NASDAQ are retreating a bit, although really they're little changed here. Financials and industrials, the big gainers here. Healthcare and consumer staples were the losers. And of course, we have to look ahead because for tomorrow's trading, a lot of tech names in focus.
Right.
After the bell, Intel reported results. Earnings per share for last quarter beat analyst estimates, as did revenue for the outlook. Intel says that first quarter revenue will be higher than what analysts are looking for, and first quarter gross margin, which is the only profitability measure that it gives, forecast that it gives, will also be higher than the consensus, 63% plus or minus a couple of points.
Meanwhile, we got PayPal earnings also after the bell. That stock is falling. It's down just under 2%. People not liking the outlook. The company did not reiterate its earlier three-year outlook for fiscal year 2017. It now sees EPS of $1.69 to $1.74. That's at the low end of range. That the estimates had been $1.74. Kind of same story on revenues, a little bit at the low end of the range. So mediocre results, inline earnings, but not a great outlook.
All right, let's also move on to Microsoft. As for the quarter ended, profit and sales better than anticipated. All of this does not include LinkedIn, which Microsoft acquired because you don't really have comparisons that way. And so all of this, keep in mind when you're talking about revenue and profit for the fiscal second quarter is ex-LinkedIn. The stock up by 0.75% in after-hours trade.
And finally, we got Starbucks earnings after the bell out, too. And those are also pretty mediocre. Sales missing estimates, slight miss on same-store sales. Also citing mediocre demand in Europe, which is interesting because we were just talking to the Royal Caribbean CEO, talking about how the European consumer was coming back. So it's obviously not across the board with everything. And you see the stock down there over 3%.
Also, what'd you miss? Alphabet's profit missed analyst estimates after the company spent heavily to market new consumer hardware. Bloomberg's Caroline Hyde has some more insight on the numbers. And Caroline, you just got off the phone with an Alphabet representative. Tell us what you learned. What was the message they wanted to send?
Well, Scarlet, I think they might be rather distracted by the fact that share price is currently down more than 2% in after-hours trade. This is rare. Usually the last 8 times out of 12 we've seen shares rise after the earnings. So they might be surprised because it seems to be laid at the feet of earnings per share missing. Now, the person I spoke to, a representative of Alphabet, was saying, look, this is due to a one-time tax item. This is due with US taxes being recalculated. That's what they tried to say was at the heart of the earnings per share issue, but revenue grew more than 20%, operating income grew more than 20%, and they say in particular mobile, YouTube, search, this is where the growth is. I think it's notable though, as you mentioned, many people looking at the marketing spend, looking at the ramp up in costs. $3.1 billion? How much are they spending on the new hardware, on the Pixel phone? This is the question the market is asking. This is why we might be seeing those shares falling after hours.
Now, it's kind of a mixed picture on the cost thing, because on the one hand, they're pulling back on some of those big moonshot things, some of those projects that maybe had no path to visibility for profitability. They're sort of more fun projects. But these other hardware things that they really want to make a bet on and make money in the phone and so forth, that's still they're spending aggressively on?
Exactly, and they sort of separate them out. There's the other business and then there's the other bets part of the business. Now, the other business is actually what's tangibly happening right now, the cloud. We're seeing a big bet on the cloud. They're trying to play catch-up with Amazon, with Microsoft, and they say actually that's the fastest growing part of the Alphabet business. They saw 62% uptick in their other business. We also saw growth in particular in hardware, as you mentioned, the likes of the new Pixel phone coming to the frontier. They're also, though, trying to make a dab hand at some other particular areas of the business. I think it's notable, though, at the moment, certainly they are pulling back from some of the other bets, as you talk about. They have been reining back drones, reining back satellites. The new CFO really trying to get a handle on the costs here.
Right, and we were looking at the numbers here for those moonshot businesses, which they put under other bets. An operating loss in the quarter of $1.09 billion, revenue of $262 million. Were they able to give some context around those numbers?
Yeah, because actually those costs don't seem to be being reined in that quickly, as far as I can see. They were $1.2 billion loss last year, and it's $1.1 billion this time. So Ruth Porat perhaps not kind of getting a grip as quickly as she'd like to. But notably, I think that they are seeing some growth in revenue, and that's coming largely from the likes of Nest. We understood that it's likely to be seeing fiber adding to that revenue growth, and notably their medical area of the business, Verily, which actually got some investment from Temasek today. They've been doing an outperformance in that part of the business. But you're right, there's still a lot of money being pumped into that. But I think, according to the spokesperson I spoke to at Alphabet, they're very excited about the opportunities. So I don't think you'll suddenly start seeing them move away from these moonshot bets anytime soon.
And then finally, just the core paid clicks business, the bread and butter of the entire company, is that showing any signs of fading?
No. 36% growth. We saw the paid per clicks rise at an even faster rate, but the cost per click, that actually is starting to fall at a faster rate. So basically, the advertisers aren't paying as much per click, but they're probably buying more adverts. So is this mobile creeping in? We know that mobile is the dominant force for Google. They have about 95% of the advertising mobile market. Is it because they can't charge as much for mobile adverts? And so, therefore, you're getting downward move in cost per click. But luckily, you've got more people wanting to buy those ads.
All right, Caroline Hyde, Bloomberg News from San Francisco. Great overview of those Alphabet earnings. Thank you very much.
And one more name to add to the earnings mix. Wynn's stock is trading in late in after-hours trade right now, and it is moving up by 5.74%. Now, when you look at the numbers, a mixed read here. Fourth quarter adjusted earnings per share missing the consensus estimate. Revenue was better, slightly better than anticipated. Macau operational revenues $500 million when analysts were looking for $860 million. But it's the commentary during the conference call. Wynn saying that the mass market business in Macau is good, and January in Vegas is ahead of last year. In addition, Wynn Resorts' CEO says construction barricades are coming down in Macau as well. So perhaps all of that playing into the stock moving higher.
And of course, this gives me a chance to bring up one of my favorite charts in the world, Macau gaming, which I always bring up. And just look up, back here, we could zoom in. Back in early 2015, it was down 40% year over year, the growth in Macau. Now up to 8% year over year, a little bit of a tick down the last month, but still such an acceleration coming off. So interesting to see that Wynn is reiterating that Macau is strong.
It's a great proxy for China overall.
Love this chart.
This is Bloomberg. What'd you miss? Intel reported fourth quarter results just moments ago. We go now to Bloomberg's Corey Johnson in San Francisco to help us break down the numbers. And Corey, Intel has been on a mission to turn from a PC chip maker company to a data center and Internet of Things type of company. How's that transformation going?
Well, it's continuing apace. I mean, this is a story that Intel likes to tell us all the time, is that they don't think of us as PCs, think of us as servers, PCs, and think of us about Internet of Things. Think about us of other kinds of chips, memory and modems and so on. The problem is, the old business is massively profitable. The new business is an open question mark as to where those profits can really come from. It's not just about making chips, of course, it's making profit with those chips. So the quarter that Intel just reported was pretty strong. And indeed, the margins were pretty solid here. So I got to talk to the CFO of Intel, Ian King, our excellent semiconductor reporter here at Bloomberg, and I both did a quick conference call with the CFO and got some notion of what they're seeing there. One of the things he said, talking about revenue guidance for the year, he says, we enter the year with a somewhat cautious view on PC TAM for the year. That is a total addressable market size for PCs. So they have seen their share in the PC industry increase. They've seen in a world where there are fewer PCs being sold, Intel's seen its revenues in PCs grow, and their margins actually remain pretty strong. So what that suggests is they're not chasing the very bottom of the PC industry, and that they're gaining market share with every consecutive quarter. But they're worried that that total addressable market, the numbers of PCs sold in 2017, will be a headwind for Intel.
This idea that they want to get out of, or expand beyond that core chip market seems to be kind of a theme of all the tech companies. All of them have these really profitable core businesses, but want to be known for something new. The company, as you mentioned, wants to get into Internet of Things, cloud stuff. Do we have any kind of numbers on profitability of that stuff? Like, what do we really know about how these are moving the dial for them?
Yeah, look, what they're categorizing as their other business outside of servers and data center and PCs. That business has been growing, and it's growing faster than the rest of their business. So they do seem to be having some success there. And in terms of profitability, the overall gross margins have been solid. But part of their sort of reluctance to raise gross margin guidance for the coming year is the notion that these new businesses have lower gross margins. It's the other quote that I got here for you from their CFO, where he talks about this business of being in other businesses. We expect ASP performance, the average selling price, to be a little bit better as we bring new products for the data center business. But, and that's the catch, we're looking at the same time at higher growth of low margin products of memory and modem. And that's the key here. They've got to grow, they've got to sell a lot of modems and memory chips to make up for the loss of profits in their other businesses, because fundamentally those are lower margins businesses, but that's where they expect most of their growth.
So in these lower margin businesses where the growth prospects are better, who's their competition, and how do they stack up against those competitors?
You know, it's across the board, from companies that are doing very smart logic like Qualcomm to companies that are companies that are putting out arguably dumber chips like Texas Instruments and so on, and analog chips. It's really a question about what those chips are going to look like at the end of the day. And it's not so much about standards, although that certainly has something to do in the radio side of the business that Qualcomm's been so dominant in, but it's really about what the use cases are. How smart are the chips going to be in automobiles when there are so much more in automobiles? What are Internet of Things chips going to look like, and how much do they need to seed the market with cheap stuff that every designer and developer of these things can use, and complex stuff that can process that information before it hits the cloud and before it hits the data center, which is most likely going to be powered by Intel.
I was looking at some analyst notes before the earnings report, and Pacific Crest sees the company offering an attractive dividend deal. Did Intel say anything about use of cash and returning some of that capital to shareholders?
In the press release, they talked about buying back shares, and there are big efforts there to buy back and reduce the share count. We didn't talk to the CFO about those specific subjects there, but one can expect we'll get more questions on the call about that as they start to address their entire investor base in a conference call momentarily. And
in the meantime, we're seeing Intel shares trading lower by 0.4%. Corey Johnson in San Francisco.
Thanks, Scott.
Up next, the feud between President Trump and Mexican President Enrique Peña Nieto gets a little deeper. We'll break it down with a former NAFTA negotiator and the former economic head of the Mexican embassy next. This is Bloomberg. I'm Joe Weisenthal. What'd you miss? President Donald Trump says the plan to scrap a meeting with the president of Mexico was a mutual decision. He spoke earlier at the annual GOP retreat in Philadelphia.
The president of Mexico and myself have agreed to cancel our planned meeting scheduled for next week. Unless Mexico is going to treat the United States fairly, with respect, such a meeting would be fruitless, and I want to go a different route.
And some headlines now from White House Press Secretary Sean Spicer. You're looking at the Mexican peso right now, which Joe is going to pull up on his computer. Sean Spicer is saying that a 20% border tax is just one solution. And some context here is that the Mexican peso gave back some of its rally yesterday after Spicer said in his daily press briefing that a plan is starting to take shape to pay for this wall along the border with Mexico through a tax policy. And he floated this 20% tax on imports from Mexico. And now he's saying that this 20% border tax is perhaps one solution. It's a cost-benefit analysis to consider the tax. Again, according to Sean Spicer, the White House press secretary. Joining us now to discuss is Antonio Ortiz Mena. He is the former economic head of the Mexican embassy and the current Albright Stonebridge senior advisor. So, Antonio, let's get your context here on the initial tweet by Donald Trump to Mexico about saying that you will pay for the wall and the president's response. Was he left with no choice but to cancel his meeting?
Yes, President Peña Nieto was left with absolutely no choice. Even before the tweet, leading political figures in Mexico across the political spectrum, from the left and from the right, had strongly voiced their opinion that the president should not go. And after the tweet this morning by President Trump, there really was no option but to cancel the trip.
I know this is very difficult, especially with the seeming unpredictability of the new administration. But where do you see this going? I mean, already Trump has called for a renegotiation of NAFTA. What is Mexico's response to that call from Trump?
Well, the Mexican government was willing to engage with the Trump administration in a renegotiation or an update of NAFTA. In fact, the foreign minister, Videgaray, and the minister of the economy, Ildefonso Guajardo, are in D.C., and they held top-level discussions with White House advisors to President Trump. And this tweet this morning, eliminated any possibility of President Peña going there. So the Trump administration, and in particular the tweets by President Trump, are really narrowing the range of possible agreements between Mexico and the U.S. The Mexican government had been, very constructive, very cool-headed in trying to have a constructive engagement. But under these circumstances, it is very, very difficult to do so. I would say that President Trump, with his latest tweets, has managed to do something that perhaps no president from Mexico had done since the 1938 nationalization of the oil industry with President Cárdenas. That is to basically unite all Mexicans. This is a pretty unique situation and, a pretty troubling developments, I must add.
That is remarkable. Now, one thing that needs to be pointed out here as I look at further headlines from Sean Spicer, he's saying that the Trump administration is talking theoretically about a border tax and that the 20% tax could be on any country with a trade deficit. As a negotiator, Antonio, do you take what Donald Trump says literally or perhaps theoretically, metaphorically? I mean, even with the wall, it may not be a physical wall, as the White House has made clear. It could be a fence. It could be drones. It could be a virtual wall.
Yes, the problem with this is that you cannot, negotiate everything in public. You have to agree, about some basic guidelines about the negotiation, and the main end of the negotiations, to reach a win-win solution, and yes, to see how Mexico and the U.S. can work together to create employment on both sides of the border. But if you start unilaterally saying, I will build a wall and you will pay for it, and one way for you to pay for it is for me to impose a 20% tax on Mexican exports going to the U.S., I don't think that creates an environment where constructive discussions are possible. Just, assume the following. What if the Mexican government would be following the same position? If the U.S. in the future would have a trade surplus with Mexico, then we would tax U.S. exports to Mexico. And it makes no sense. It makes absolutely no sense. And I think that the discussions should be focused on how the countries can work together to address real economic challenges in both countries and to create jobs in both countries. But this is exactly the way not to go about it.
What would a real constructive negotiation focus on, in your view? What should be up for discussion?
First of all, I would say, clarity. What happens until Mexico and the U.S. reach a new trade agreement on a new trade deal? Well, there should be something like a peace clause. Don't create any noise. Don't come out with, strange proposals that are completely NAFTA and WTO inconsistent. Don't tweet while you're negotiating. So we will live with NAFTA, we will negotiate, and we will make sure that that negotiation benefits both countries. Among the issues that can be discussed is rules of origin. Does he have regional? That is, say, North American production can be enhanced. We could discuss about trade and environmental provisions. NAFTA's provisions are pretty old, quarter century old. We could discuss about e-commerce, state-owned enterprises. What about energy? Mexico just implemented a far-reaching energy reform. We could discuss energy. We could discuss telecoms. But no, Mexico's just being faced with a sort of barrage of ideas that create a lot of uncertainty in the Mexican economy that pressure the Mexican peso. And I don't think it would be right to negotiate under such an environment.
All right. Well, Stonebridge Senior Advisor Antonio Ortiz-Mena, thank you for joining us today.
Thank you.
Coming up, what you need to know for tomorrow's trading day. This is Bloomberg.
Tomorrow, where we're looking for more headlines, UK Prime Minister Theresa May will be meeting with President Trump at the White House. That's at 12 p.m. Eastern Time. The two will almost certainly discuss any kind of trade agreement between them.
And I'll be looking at U.S. GDP out at 8:30 Eastern Time.
This is Bloomberg.
This.
I'm Elisa Parenti, and you're watching Bloomberg Technology. President Trump says the plan to scrap a scheduled meeting with the president of Mexico was a mutual decision. He spoke today from a GOP retreat in Philadelphia.
The president of Mexico and myself have agreed to cancel our planned meeting scheduled for next week. Unless Mexico is going to treat the United States fairly, with respect, such a meeting would be fruitless, and I want to go a different route.
The president said most illegal entry into the U.S. was from the south border. He wants a 20% tax on imports from Mexico to pay for the wall. Meantime, the Customs and Border Protection Agency says Patrol Chief Mark Morgan is stepping down. Morgan's last day will be Tuesday. His departure comes after the administration's decision to greenlight the wall at the Mexican border. A wave of top State Department staff has resigned as the Trump administration takes over. It's reportedly the largest wave in recent history at the department. And genetic engineers have successfully grown an embryo that is part pig, part human. Scientists injected human stem cells into the embryo of a pig and planted it in a sow. It later developed the precursors of various human tissues. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti.
I'm Caroline Hyde. This is Bloomberg Technology. Coming up, a packed hour of tech earnings ahead with Alphabet, Microsoft and Intel all reporting after the bell. We'll fill you in on the rosy outlooks and the big misses. Plus, creating the biggest power couple in wireless space. We'll break down the secret meeting between the CEOs of Verizon and Liberty and the consolidation race in the industry. And after the 2016 private equity explosion in Silicon Valley, we'll get the lay of the land for 2017 from the co-head of tech from Permira. First, to our lead. Alphabet reporting fourth quarter profit that trailed estimates. If you look inside the Bloomberg, shares dipping in extended trading. Go to GIPA. You can see those sorts of moves. Earnings per share fell short of expectations, but that's due to an increase in the tax rate. Alphabet posted a 22% tax rate growth during the quarter. That's up from 5% last year. However, there were a few bright spots. The company continues its stronghold on advertising, beating analyst expectations on paid clicks, up 36%, and narrowing slightly its operating loss for the Other Bets division. Joining me to break down all the numbers is Bob O'Donnell.